Hi and welcome back to Money Managers, a User's Guide. I'm Nathan Peters. This week, I'd like to address the biggest thematic trend in the buy-side industry, and this trend appears to have legs, eliciting a full-throated regulatory response in Europe and capturing the imagination of the investing public at large. Here's the obligatory Google search trend chart. Yes, I'm talking about incorporating environmental, social, and governance issues explicitly into stock selection processes. Now, this area is nascent and developing with two clear ESG analytics frontrunners, MSCI and Sustainalytics, but importantly, their findings often don't correlate with each other. In general, ESG data is spotty and poorly audited in general. Greenwashing is rife. Now, all this is preamble and well acknowledged, but as a result of this messy on-the-ground reality, I thought it may be helpful to just survey the live products I'm aware of in the space, split the universe into high active risk and low active risk, or passive funds, and see whether there is some outperformance occurring around the hype and marketing spin. Because I think that's why we would pay someone to manage our assets in an ESG integrated way. I mean, if you feel very good about the ESG side, but still lose money, that's called charity. Or being more charitable, impact investing, not investing. Right? All right, so let's turn to Venn. These lists are merely indicative and not meant to be exhaustive. I have sourced the funds from public databases like ETF.com and from being a market participant investing in active managers. Using Venn's factor lens, I split the following 18 funds listed here in alphabetical order, tickers in the description below as well, into active and passive groups, with the criterion being less than or greater than 20% active risk over and above exposures to Venn's defined factors. There's a wide range, of course, with ESG marketed funds being anywhere from 4% active risk to 67% active risk, which just tells you what a marketing slogan ESG really is. So let's pit the actives versus the passives against each other over the common period, which happens to be only the last 9 months back to August 2020. As you can imagine, the passives trump the actives in this bull market period, returning more than 31%, which is 3 times the actives over the period. But of course, longtime viewers know that we don't take performance at face value. We dissect what is driving returns so that we can understand if it's worth paying for. If we go down to the beta chart, here, we see that passive ESG funds are long equities with slightly higher beta. They're long FX risk and short the US relatively. The actives, in addition, are long interest rate risk, long momentum stocks, and long quality stocks. All understandable given ESG mandates, composition, and the recent popularity. So where have they made money? Well, not surprisingly, the passives made 92% of that nice return from just being long stocks. So you get some peace of mind with better ESG scores than the broader market, but so far, if you paid much more than passive fees for those funds, you paid over the odds. If we switch to the active managers, however, and they have a much higher risk weighting on their ESG process, among other things, we see a more significant return from those activities at 2.5%, and not statistically significant yet. We may need to revisit this topic to have a representative sample size given how new the sector is. However, we can zoom in and see where the performance is coming from. Force ranking managers by how much value they add. And here we have it. There's a wide range of outcomes with Ecofin, Marshall Wace, and Fulcrum above 5% alpha over the common period, with others more pedestrian or even negative. As we tend to say, it's a good start for those funds, but the proof will be in the long-term pudding as we go through market cycles and see how the ESG hype cycle evolves. Incidentally, the passives exhibited a similar spread in terms of skill, but the low percent of risk they take in that area means the effect is washed out by more dominant mainstream factors. That's it for me this week. Thanks for making it this far with me on Money Managers, a User's Guide. If you found this content useful, please like, comment, subscribe, and hit the bell for notifications of future episodes. And remember, use your money managers. Don't let them use you. Thanks.